Welcome everybody to the February 2021 Markets Update. My name is Matthew Cassidy, Managing Director. What I'd like to cover off today are three main things. Observations on the global macro issues we're facing into 2021, well certainly the start of 2021. We are in the midst of the reporting season for the Australian share market. It's almost like the report card on a 6-monthly basis. We'll cover off our observations on the global markets at the current point in time. In terms of the global macro issues at the current point in time, we're at the stage of the observations about the impact of the ongoing coronavirus issue. Vaccines are starting to get rolled out, which we're seeing is really starting to accelerate. There's even some conversations that international travel will be playing out in the second half of 2021. However, the governments are still injecting huge amounts of capital and buying of assets into economies, and without doubt are going to provide some really substantial support of world economies. However, we have started to see bond yields increasing. So what does that mean? Well, when we see the cost of capital effectively increasing, that can be a natural concern for companies that use low interest rates to certainly grow their earnings. We've seen really over the last 2 weeks some of the larger cap companies in the world starting to really pull back on some incredible performance over the last 3 or 4 months, and we're also watchful as to what that could be doing in the world economy. On sort of global or macro issues on the domestic front, we still haven't quite seen the impact of the tax cuts, the low interest rates, and also the really large degree of savings that households have had as a result of not normal consumer spending. However, some of the companies into the reporting season based upon domestic consumption have really been performing very well, and we think that this will continue to play out into the year. So how have we gone in the Australian reporting season? We've seen about a 10% increase on company dividends, almost a $7 billion increase. And in this 12-month period, we're seeing a $73 billion payout of dividends into the economy based upon Australian shares. So anytime we're seeing a growth in dividends, it's obviously companies have been managing their affairs really well, and certain segments of the economy have been performing incredibly well. Two of those key segments we've been paying particular interest to is certainly the miners. Obviously the iron ore price has been very strong. Copper has performed very strongly, and with those companies still exporting a lot to the likes of China and other parts of the world, record profits have been unfolding, which is excellent. Our preferred holding has still been BHP, which have had a really good period on. We've also seen the banks reporting, and the banks have also been making some really good profits, also off the back of what the potential losses were from post-COVID related issues not playing out as badly as first thought. So they've effectively been writing back a fair amount of their potential risks back onto their P&L and been producing some really good profits. The performance of the banks is really important to the domestic economy because like we saw in the GFC, a really strong banking system which effectively supports the growth of the domestic economy is really, really important for all of us. So again, it's been really positive to see the banks perform to that particular level. However, as we're looking at the Australian share market, we're starting to see valuations looking very stretched. Long-term average of the market is around about 15 times, and we're sitting around about 20 times at the moment. So naturally, when we see that occurring, we are very cautious, and we are also trying to time our way into specific assets that we think will perform. So we don't think this is an environment where you can just set and forget in the share market or the economy. You have to be very selective about what you're doing. So certainly the signals are up on a risk management basis at the moment. Then on a global front, as we naturally watch the US market as a key lead indicator, the reporting season has also been very positive. Again, led by the big techs, but a lot of the big tech companies have actually come off recently as a result of what we commented before, the fact that bond yields have been increasing. So again, with a really, really strong performance over this last 6 months, being very cautious about where we invest capital at the current point in time. One decision we made about 3 to 4 months ago was emerging markets, and certainly one of our top performing funds at the moment is the UBS Emerging Markets Fund, which has had an unbelievable record over this last 4 to 5 months. So again, I think these are key decisions we need to be aware of to make sure we're putting capital in the right place at the right time. And really important at the moment, we be very careful about not just investing in the market, being very careful about when we do. And I also wouldn't be surprised if we do see in the next 3 to 4 months, a period of market volatility where we do see a 5 to 10% pullback. So any clients with capital, have a conversation with your advisor. Let's be selective about when we get in, and preferably in these periods, keep a little bit on the side with new capital to make sure we can buy when the timing is right. We look forward to a further update next month. Thank you very much for listening.